Hi, welcome to the first mini lecture for Chapter 5. In the previous 4 chapters, we concentrated on learning the accounting system, which resulted in the financial statements. In this chapter and going forward throughout the semester, we are going to take a tour of each balance sheet account and the special accounting issues related to it. We will begin with cash in this chapter, and we will be learning about internal controls at the same time, since they are especially important with cash. This is my favorite chapter of the semester. Students can immediately relate to it because it involves things you see and do daily. Most of us all shop, and you're exposed to internal controls in the shopping process. You may not recognize them as such when you were shopping, but after this chapter you certainly will. Many of us have checking accounts, and we will be learning how to reconcile those. And many of us have jobs, and those will have exposed us to internal controls as well. And perhaps finally, some of us may find the topic of fraud interesting. Those of us who own businesses now or intend to in the future will find this chapter the most helpful of the semester because you will learn how to prevent fraud within your business. So let's get started. Hopefully you've printed out the Chapter 5 summary notes. If not, please stop the video and print them out because I will be using them during our lecture today. Let's take a look at the definition of fraud. Fraud is generally defined as an attempt to deceive others for personal gain. The legal definition of fraud is a bit different. It states that fraud is an intentional false statement that is material, which means significant, and is relied upon by another to their detriment or harm. Our version is a bit simpler, but that's okay. It focuses on the fraudster instead of the victim, and we are going to be focusing on employee fraud specifically in this chapter because businesses, both for-profit and not-for-profit, often fall victim to it. There are 3 types of employee fraud. First, corruption. That involves misusing one's position for inappropriate personal gain. For example, a company may have a purchasing agent who makes a deal with a supplier to recommend his business if he kicks back money to the purchasing agent. Asset misappropriation is the second example of employee fraud. And to help us understand the terminology, to appropriate means to take. To misappropriate is to take wrongly. This is basically stealing. And if we're talking about cash, stealing cash, that would essentially be embezzlement. And cash is usually the target, but other assets can be misappropriated. Employees can take stock or inventory of a company, or there may be long-lived tangible assets, such as a piece of equipment or machinery that could be stolen. We'll talk later on about how to prevent these things. The third type of employee fraud is financial statement fraud, and that involves misreporting amounts in the financial statements, usually to portray a more favorable financial situation than what actually exists. Now let me just pull a page, I should say, out of our textbook so I can show you something here. Okay, on the left side is the frequency of the fraud. Asset misappropriations, which is stealing, involves 65% of the frauds. Corruption, misusing your position for personal gain, is 28% of the frauds, and financial statement misreporting, only 7%. Yet, financial statement fraud results in the greatest losses, as opposed to corruption or asset misappropriation. So why would employees commit financial statement fraud? Well, we're going to take a look at what's called the fraud triangle. There are really three different items that need to be present in order for employees to commit fraud. And I'm going to, while I'll refer to my notes, I will be showing you what the fraud triangle looks like here. Okay, first of all, there's incentive or motivation. The employee has a reason for committing the fraud. Maybe it's personal financial pressure or just a desire to live beyond your means. Maybe it's because the company is not meeting its loan obligations. We call those loan covenants, lending agreements, which require the company to achieve certain financial targets, such as to keep a certain amount of money on hand in the bank, to have a certain current ratio. And if the company does not meet those loan agreements or covenants, then perhaps a higher interest rate kicks in, or perhaps more collateral will be required, or even full payment. And maybe it's that the employee simply wants a bonus or a raise, but there's some type of motivation or incentive that causes them to want to commit that fraud. Secondly, there's the opportunity. The employee has a means of committing the fraud. And usually that indicates that there's a lack of internal controls. We're going to be learning about what they are shortly, but basically there's nothing in place to prevent the fraud from occurring. And the third portion of the triangle is rationalization. The employee perceives the deed as justified or perhaps unavoidable. Even though they know the act is wrong, they've convinced themselves that they should proceed with the action. Their sense of personal entitlement perhaps outweighs principles such as honesty or justice or fairness to others. Now let's take a moment to talk about the Sarbanes-Oxley Act. And I've highlighted these sections of the text here because this act is the most sweeping act involving companies and corporations since the Securities and Exchange Acts of 1934 and 1933. And that's basically what we're told here. All companies that trade on U.S. stock exchanges must comply with the requirements of the Sarbanes-Oxley Act. And for short, we'll call that SOX. It was created in response to financial statement frauds that occurred in the early 2000s. And there were quite a few. We had Enron, WorldCom, Parmalat, HealthSouth, Adelphia, quite a few frauds. And confidence in the stock market had been shaken. Why? Well, because people were afraid to trust the financial statements. They couldn't believe in them because they were not accurate, and people, when relying upon them, lost a lot of money. If you remember in Enron, people lost their jobs and their retirement plans because they were told by CEOs and CFOs to invest in their retirement plans, to buy stock of Enron. And then when Enron fell apart, the retirement plans fell apart and their jobs went away. Many people were hurt. But as we mentioned, this wasn't the only company. Tyco, WorldCom, HealthSouth, Parmalat, and locally we had Adelphia. So because of all these frauds, investors were reluctant to invest. And if people are not investing in the market, in stock in different companies, then the economy has a potential of grinding to a halt, right? So we wanted to restore investor confidence in the marketplace and in financial reports that were being produced by these companies whose stock is traded. So let's take a look at the fraud triangle again and talk about how the Sarbanes-Oxley Act addressed some of the problems that exist with fraud. Okay, first of all, let's talk about those incentives. We said often people have a sense of personal entitlement or they have financial pressures. So how did the Sarbanes-Oxley Act address that? Well, those who willfully misrepresent financial results face stiff penalties and fines up to $5 million plus repayment of any fraud proceeds. Maximum jail sentences have been increased to 20 years. And what federal sentencing guidelines allow for is to declare those jail terms consecutive. In other words, if you have 6 counts of fraud, 6 times 20 is 120 years. It's not mandated, but it is possible to declare that. 20 years is equivalent to a jail sentence for manslaughter in some states. So it's become a more significant penalty, where previously white-collar crime did not yield significant sentences. Now, in terms of reducing opportunities, to reduce fraud opportunities and improve companies' internal control over financial reporting, the Sarbanes-Oxley Act requires all public companies to have an audit committee of independent directors to ensure that the accounting, internal control, and audit functions are effective. Now, what is an audit? An audit happens when financial statements are checked by independent CPAs to make sure that these financial statements fairly represent the financial position of the company. The audit does not specifically check for fraud. Their goal is to make sure that generally accepted accounting principles are being followed, which, if followed, will result in reliable financial statements, and then they issue an opinion as to whether the financial statements are or are not following generally accepted accounting principles. So, in addition to having an audit committee of independent people so that employees will not have a reason to, or interested directors would have a reason to hide fraud, we have an independent audit committee and directors to make sure that the rules are being followed with regard to the audit, and that the CEO and CFO are not getting too close to the auditors to be able to influence their opinion. That's exactly what happened with Enron. The CEO and CFO became very close to the audit managers, and the audit managers were influenced by the CEO and CFO not to report fraudulent actions. So having an independent committee counteracts that. Also, these internal controls that we're going to be talking about in a moment are the policies and procedures that will help prevent fraud. Management is primarily responsible for establishing them and evaluating them. However, due to the Sarbanes-Oxley Act, we have those internal controls also audited to make sure that they are not only written down, but they're being followed and that they are effective. Now, what about encouraging honesty? This is a difficult one because it's difficult to know what's going on in someone's head and to hire someone who is proven as an honest person and is not going to rationalize any type of theft, other than making sure that you check their employment record and to see whether they've committed any embezzlements. There's not a lot that you can do. However, what Sarbanes-Oxley has implemented is whistleblower tip lines. Let me show you an example of one. I had to blacken out the company that was involved because a student had given me this. But for example, this is what companies can do. They can post a notice where employees would perhaps sign in for the day or check in, or maybe in employee lounges. And this notice asks employees, are you concerned about questionable accounting or financial practices? Do you think a fraud may have occurred? Are you aware of intentional or attempted circumvention of accounting internal controls? If so, then they give you some options as to where to report it. I would always go to the highest level, in this case the audit committee chair, because you don't know whether a supervisor or a director is involved in it. So I would go to the highest level, the audit committee chair. It says if you tried the above and still have concerns, or if you wish to remain anonymous, and I would suggest that you do so, they give you an 800 number to call. Now, the reason why I'm saying you should perhaps remain anonymous is that action can be taken against you. Perhaps whoever's in charge could try to make your life difficult by demoting you or changing your work conditions. Now, if that happens, then the Sarbanes-Oxley Act does offer remedies against that, so that if someone had perhaps fired you or demoted you or cut your pay, for example, if you are retaliated against, there is legal protection to whistleblowers. So we would, you are protected. However, you would want to make sure that if any of those things happened and you were retaliated against, please visit an attorney, because certain forms have to be filed and notification has to be given in order for those legal protections to be effective. Another thing we have done is that through SOX is to require companies have a code of ethics to make sure that the message gets across to employees that ethics matters. Okay, so let's turn to the next page and let's discuss these internal controls a little more fully. Okay, so the internal controls are the policies and procedures that exist at all levels of the organization to achieve these 4 objectives. The first one here is an operational objective. We want to make sure that folks that are working at the company are achieving are working efficiently and effectively, because the operational internal controls not only involve preventing fraud, but also the policies of the company are followed to make sure that the company operates effectively. Also, we want to make sure that assets are protected against risk of fraud. Those are both operational controls. The next one is a reporting control. We want to make sure that the accounting information is reliable and reported on a timely basis. And the last internal control goal or objective is to make sure that the company is adhering to all laws and regulations. So not just generally accepted accounting principles, but also OSHA regulations, EEOC regulations. There's lots of agencies that regulate corporations. We want to make sure they're all being followed just to prevent risk of loss due to fines and regulatory action. Okay, so this next section, the components of internal control, we're going to be focusing on the control activities, but let's talk about them all anyways, just so that you know the framework of the internal control systems. First of all, the control environment refers to the attitude people in the organization hold regarding internal controls and is influenced by the policies of the company's board of directors and senior management. In other words, we want to make sure that everyone across the company realizes that internal controls are important. Integrity and honesty matter. So we call this the tone at the top, the tone that the executives set for the company. The next component is risk assessment. Managers should continuously assess the potential for fraud and other risks that could prevent the company from achieving its objectives. The third component is the control activities, and we'll be talking more fully about those in a moment. They include various work responsibilities and duties to reduce any unacceptable levels of risk. In other words, this is how we prevent the bad things from happening. Fourth, information and communication. An effective internal control system should generate and communicate information about whether those activities, control activities, are being followed. For example, if a teller is not supposed to have an account or make transfers into their personal account at a bank, then we should have some type of warning system, a red flag, that alerts bank managers that tellers are having activity in their own personal account at the same time they're engaging in teller duties. The danger there would be is a teller taking money from a customer's account or cash from a customer and putting it in their own personal account. And then finally, monitoring activities. The internal system needs to be evaluated itself to make sure that it is working. Okay, so you don't have to worry too much about the components. You do need to know the objectives of internal control and then the control activities, which we're going to be talking about now. Now you've got your notes here. I'm going to ask you to add a few things, but instead of using the notes, I'm going to pull out a page of the textbook again, and we'll come back to these so that you can write these in your notes in a moment. I like this page 219 chart because it gives examples as well. Okay, so these are 5 common principles of internal control. Here are the principles or the control activities. The first one, establish responsibility. That's what we try to do there is figure out who did it. Try to assign each task to only one employee. An example of that is having a separate cash register or cash drawer for each cashier so that if there's a shortage, you would know who caused that shortage. This second one, I think, is the most important of the control activities, and that's segregation of duties. We try to assign related tasks to 2 or more people so that one person couldn't take an illegal action and then cover it up. I'd say the most important thing to do is separate record keeping from access or custody of the asset. For example, the cashier does not make journal entries in the accounting system, and the accountant or bookkeeper should never handle cash. Otherwise, money could be stolen and recorded incorrectly to hide the theft. So I'm going to have you write a few things in your notes. In establish responsibility, I added the words who did it to help us remember what the goal of that is. And next to segregation of duties, perhaps you can add these notes. Assign related tasks to 2 or more people. Always separate record keeping from access or custody of that asset. And I'll give you a minute to write that down. You can always stop the video and come back to it. Okay, the next item is restrict access, and you're probably very familiar with this. This involves physically locking up valuable assets or electronically securing access to assets or information. So, for example, having a password or having a special to access information. It might be locking expensive items behind display cases if you're in retail, but making lower cost items available for inspection. The use of a safe or a vault. Those are all examples of restricting access. And when we talk about access, we mean not just to assets, but to information as well. The next control activity is documenting procedures. Prepare documents to show activities that have occurred. We want to document each business activity to create a record. For example, if goods were shipped, whether customers were billed, and so on. And what you might want to do to that part of your notes is to assign sequential numbers to documents that you create within the company. That way, if a document is missing, for example, a check, then we would be able to see that and know about the missing documents. And the last one is independently verify. Please correct your notes if you have a mistype there. Independently verify. Companies hire someone to ensure work is done by others, or within the company, you can have folks check on one another's work. For example, a supervisor might recount an employee's cash drawer just to verify. We're going to learn a method of internal control called the bank reconciliation in another, I believe it would be in the third mini lecture. So basically, it's a system to check on others' work. Okay, let's talk now about the limitations of internal control, and that'll be our last topic before we end this first mini lecture. Internal controls can never completely prevent and detect fraud for two good reasons. First of all, good internal controls are expensive, and the benefits should never outweigh the costs. So, for example, if you want to completely eliminate shoplifting, you can hire lots of security guards to follow all of your customers. Well, first of all, it might result in lost customers because no one wants them following around. But secondly, the payroll of having to keep so many security guards on the payroll would be much more than the amount that you may lose. Secondly, humans are involved. So some folks might not understand fully how the internal control works. They may be confused. They may be sick or ill and not able to fully do their job correctly, or distracted. Also, there's the issue of collusion. We might have employees work together to get around the controls. Okay, that ends our first mini lecture for Chapter 5. The next mini lecture will deal specifically with internal controls for cash. Have a great day.